What's up, everybody? We're here. We're getting at you live. It is Tuesday, April 26th, and today this is our normal live stream every day that we do. Today, I'm going to share this one out with everybody because first of all, I've just been getting a lot of DMs and emails about where we are in the market and how the best looking sell setups failing and that's a double failing squared, and how we're still playing this market with everything that's going on. And so you know what, instead of trying to respond to every email and DM about this or that, I figured I would just send out my whole review, or this is what we do every day, our daily review across our universe of products that we trade in prop trading, and not really focus too much on the hearsay and the freak out of the moment. This is why we do systematic trading. This is why we, when we're in different market regimes, we make adjustments to that market regime. What worked in April, May 2020, right out of COVID, all through the summer, what worked then is not going to be working right now. We're in a different market regime, and it's, you can see it because this first of all, this sell-off from the January peak basically to now, that's taken 4 months, right? About 4 months now. To do, almost coming up on May. So we're getting up to like 5 months to do. COVID lasted like 3 weeks, right? So it's buying these dips are, it's a different environment. It's a slow grind down. You can see it, 14th of March to, so 2 weeks to go up, and then, like 3 weeks to go down. It's a slower grind down. It's a faster spike higher. We're making another attempt down. We've got a 3 dive pattern showing up. Like, all these things are potentially bearish. All these things are scary. The bears who have been wrong for the last like 12 years, 13 years, are finally starting to feel, well, 2020, they were right for 3 weeks. 2018, they were right for, about a month, maybe 3 months. 2014 through 16, they were just wrong. It was a sideways market. And then, every day past February or March 2009, they've been wrong. But they've been right here. They're finally right. And, I'm sure it feels good. This is where you get all the subscribers in the world, all the followers. You're the Lion King of bear markets, and it's great. Of course, we know statistically that when we look at the time spent in these markets, if we were to take a look at the last 70 years on the S&P 500, it spends about, well, let's call it 14% of its life in a bearish regime, so bear quiet or bear volatile, and 85% of its life outside of that. So statistically speaking, we would know that this is going, and it may last. It may last a while. That's also fine. And it's great because we know that we have systems to trade these market regimes. Likely, you're going to end up in a neutral 2-ways market. But as we make our attempt down to this bottom, who knows? So luckily we have our tool, the SQN, to help us navigate that helps give us direction. It tells us what the temperature is, what the calendar and the map tell us is, the location and the time of year. From that, you can deduce, what sort of clothing you would need to wear in a place, right? And that's what we use with the SQNs. We need to understand what market regime we're in so that we can apply the correct tools to that market. And since we are prop traders, a lot of us, or we have, accounts like at Interactive Brokers where we have access to currency markets and futures markets and option markets, or equities, I guess. And we trade crypto and we trade, pretty much everything, commodities. We don't need to, we don't need to feel the pain of an equity sell-off. Now, there is, just before we get going on our analysis, there is always some, there is contagion across the board. And one thing we want to consider right now is, the size of the bond market, which I believe is $50 trillion, right? U.S. Treasury market cap, market size is better. Okay, U.S. Treasury at some $20 trillion at the time. I don't know when this was written, but okay, April 2020, insurance 4.5 trillion. You're right. It's somewhere around 20 to 50 trillion dollars. Okay. Okay. So what does that mean? If you're owning dollars, like if you're a sovereign, like, China, or if you're like Apple, for example, and you have, $200 billion on your balance sheet, you don't own just like, it's not just sitting in a savings account. It's usually sitting in short-term treasuries because it's super liquid. It's the most liquid exchange in the world. It's backed by, the full faith and credit of the U.S. Government. And so, you can get it. And of course, banks will lend you money on that. So if you got $200 billion in cash and you're a $2 trillion company, of course, a bank is going to like fight to get your business. And so they got, they can get leverage, as much leverage as they want in the bond markets by just, getting a line of credit with banks. They've got super large amounts of equity. Now that's a healthy company, Apple, but think about the amount of companies that have that. And so there's some first order, second order things that we have to consider. And this is where the bears have been pounding the table for the last 10 or 15 years. And eventually it becomes true. The old saying, a broken watch is right twice a day, except in the military. We have a systemic risk right now. And that is the only reason that we could have, excuse me. That's the only reason that it would affect other markets that we trade. So typically, like think back to what happened in COVID, March 2020. I was long Bitcoin, I was long gold, I was long silver. I think I was long treasuries. I was long the Russell and NASDAQ. Okay. Probably you're going to get stopped out on a couple of those. Obviously, like the equity markets, those indices would get stopped out for sure. You get it. I get it. It's expected. But, you're always told that Bitcoin would outperform and gold is the safe haven during those environments, like all that. But the reality was, and this is always the case, and this is why we have everything, the correlation goes to 1 on everything when you're in a crash, right? Because it's not that the asset is bad, that it's not working, that it's not doing its job in that environment. It's that the market itself, the participants are being liquidated, right? So, when you want your store of wealth, or you want your hedge to perform, you have to understand that the timeline that you're talking about, like if we pull a 5% down day on NASDAQ today, we're probably going to have a down day on, like, look on, everything over here is currently red, a lot of red on all these currencies. What's up? The dollar. Basically all the dollar pairs are up. Mostly And then, you look at all the indices across the world. China's the only thing that's up. Energy's up. And then, some commodities are doing okay right now. Treasuries are up. So what does that mean? People are putting their money in bonds. They're moving to cash. That means they're moving to cash. And then if we take a look at our equity universe here, this is about 100 equities, right? And we can just see that it's very few. It looks like energy is like the few energy, and like probably like Walmart's up. Let's see if Walmart's down. So Exxon, basically oil is the only thing that's up right now. Okay, so that's contagion, right? You start getting market margin calls. You have to fill that. First thing to go, obviously, is the stuff that you're feeling your most pain on, probably, right? So if you're long equities or something like that, you're going to stop out there. But if you're gold is my safe haven, plan, right? So not me, but gold should be, it should be holding up, and it is right now. Palladium doing okay, up 4%. Silver's it's minor. Gold and silver are very minor right there. MINOR. Their moves, they're not down like others, and then we've got the energy complex, which is, holding up okay, pretty good today. So you're going to have, that's good. You're going to have, that play out. Let's have a look, so equities are being sold right now. We got that. If we get below, I don't know, 41, whatever this number is here, 4,100, which is where we held in February. If we get below 4,100, I don't know if it happens today. Could happen today. Could happen this week. Could just turn on a dime from here. We had a great opportunity we had a failed vol breakout overnight, and it failed. So what do we know about that? We're in a neutral market regime but we're real close to flipping into bear quiet on the SPOOs. We're in it in NASDAQ. What do we know about when our, it's a 60 to 70% win rate strategy, depending on the regimes you're in, right? It's a really good strategy. And since equity indices are designed to go higher, you reshuffle your assets and get out the bad performing assets and put in the good performing assets. So it's by design built to go up. If it doesn't go up, that's telling you something. 60, 70% of the time, it's going to win. So like 70, actually, it's probably like 72, 75% of the time, it's going to be correct. And so we had an experience where it's not correct. Doesn't mean that the market's going to crash, but we had a low risk entry, take the entry, and then got stopped out. And I took it on NASDAQ here. So let me just pull it up. So low risk entry, failed vol breakout, boom, ideal trade would have gotten us out like right over here. And that wouldn't have broken the downtrend. That wouldn't have put in an uptrend or anything like that. It didn't work. And we're continuing to go lower here. So it's not telling us that we're going to crash. What it is doing is saying, okay, we have a method to get into these trades that's low risk and allows you to get in and get out in any environment. If we were in bear volatile, I would not have been able to size my position appropriately to get into this trade. So I know that I'm not in bear volatile yet. And I know that if we are in bear volatile, I'm not going to be able to trade this thing. So I'm instantly shuffled out. I'm not playing that deck of cards, or I'm not playing that table. Let's use a Vegas analogy here, I guess. I'm only playing where I know that I have an edge, right? And so right now, the edge I had yesterday is gone, and I took a 1R stop on that, and that's just fine, right? Now remember, for the past month, I had an 8R run on this one, on the Natty, right? We had a nice run on Natty. I caught 8R on that. I take a 1R loss. Okay, cool. I had the CAD yen. We had the CAD yen last week, and we got in that late in the game. Remember, we're talking about late stage entries. We got in over here and trail stopped right there. So a simple way, most people are looking at this whole chunk of things, hoping, wishing, and dying and crying and worrying about all that. We have a very simple strategy that allows us to come in, boom, boom, knock out, 1.5R on that. If this thing was going to continue to go, cool, we could have caught it. If it was done, which, obviously that's a 10% move in a month in currencies, that's a big deal. We got in, we had an opportunity to catch it. If there was going to be a vampire riot or something in the, something in the world, we would have caught it, but it didn't happen. And so we used our techniques to get out. That's where we are. That's what we got. We use our techniques, we use our strategies, we use our systems to keep us safe when the market is doing, when everybody else is playing a game that they think they need to be playing because it worked, for the last 2 years or the last year and a half or something like that. They're going to play that game, and we're playing a different game now. We just, they're still sitting at the blackjack table thinking that they're playing blackjack, but they're actually playing poker. And they don't even realize that the game is now moved to poker. They're still playing blackjack and keeping the Vegas theme going today. So that's what we got, team. That's where we're at. And let's do what we do every day. Get in here, blast through our watch list, blast through everything. We'll have a very simple plan of attack. We went through it yesterday. I had 2 trades, 3 trades that fired off yesterday, but only 2 could have been filled because the position sizing on one of them was too big. So it kept me out of that one. That was natty gas. That's cool. That's how it works. We're long corn, and then got long and stopped out on NASDAQ. And if corn gets stopped out, that's fine. It's 1R. It's not, that's 0.25% risk per trade. That's nothing, I'll take that all day long on a 70% ish win rate strategy. Yeah, I'll take them all day long. I'll just keep taking them as long as we're in the correct market regime and the risk parameters are set up. So it's not so much just, getting in. That's minor. That's like 1/10 of the reason, or maybe 10% of the trade is why to get in. And you know what? That's where everybody loses all there's a reason so many people lose money trading. It's because so many people are focused on when and why to get in. And that is such a small part of the trade, but people put so much value on it. And, it's a simple equation. If 95% of traders fail to make money, and then everybody, a vast majority of people are out there talking about entries and thesis and all these ideas and everything, getting these highly complex, easily escapable situations they enter into, and they don't understand how to, for example, if we go back to Natty real quick, if they buy Natty right here, they're probably doing it because they're looking at this thinking, okay, we're going to $15, right? It's just a nice pullback in an uptrend is what they're thinking. And then we're off to the races. Well, if us here in the lab, we would be looking to get 2R on this trade. And again, you'll see why I was not able to take that trade. So you can see 2R is all the way up here at an all-time high, 8.48, right? And, I wasn't able to take that because the position sizing would have been way outside my risk area. And that's no good. But however, let's say today ends up how it is right now. So I'm in here. Okay. That in order to hit the price target from yesterday's bar, that's a 5-hour move on this. So here, I only need to get to, let's see if I can get it in. It's a little small here. There we go. I don't even have to get all-time highs on Natty to get my 2R. And if you are looking at that saying, but yeah, it would be great to get the 8.5, you know, why not get the 5R? Well, we have a 70+% win rate on a 2R exit. You know, it's probably like a 30% win rate on a 5R exit. So, or, you know, this move up here. So what I'm doing is instead of, and the most important part of this here is not when I get in. Well, the other 90% of importance is how big my position size is. That's like probably over half of the most important part of this trade is if I'm doing one contract here on that, then I would say that's about a quarter of the size. So I should be in 4 contracts here. So 1 contract to get 2R or 4 contracts. And I still walk away with the same amount of money because I'm only getting 2R on 4 contracts instead of trying to get 2R on 1 contract. And the 2R that I would have had to get would have been a pretty Herculean effort. Like you're asking a lot of natural gas to perform, whereas I'm not asking natural gas to do anything spectacular here. It's spectacular in that it completes the plan, but it's not spectacular in the sense that, you know, I'm asking it to, you know, go to $10 a barrel or, you know, any of that. So I'm finding, you know, we're taking these little pieces in here, you know, these little chunks right here. We're finding these little areas, little pockets where we have huge edge. And, you know, you're basically, by the time I'm getting into this, or by the time I'm looking to get out, the world notices what's going on in natty gas and they're going to be chasing it. So I can sell it to anybody I want. That's how we build our systems. We build our systems around this idea that we want to be playing the players, right? Back to the poker analogy, you know, we're not playing so much the cards we're being dealt as we're playing the players who are being dealt the cards, right? And, you know, back to even the blackjack analogy, the thing that makes blackjack card counting in blackjack, I used to do that for a living. The thing that makes it so good is not that you can predict what cards you're going to get by just counting them. The thing that it works is that you know that you're in an environment that is rich to receive face cards. So if you play basic strategy or some version of basic strategy in blackjack, then all you have to do is just know, okay, where my edge really comes in, where I really make all the money is by being correctly sized, right? Now I've blown up counting cards, playing blackjack, and betting correctly. I've gotten stopped out. You know, let's say I come in with $1,000 as a stop, and you know, I had to count. The count was on my side. I had, you know, like a half deck left, so it was like prime time to do it. And here you go, you get doubles, okay? You know, and dealer's sitting on a 6 or something like that. Okay, dealer's gonna have to hit. And so now I've got like pair of tens. Okay, I split those. And then, you know, and then I get another pair, and then I split those. You know, like you basically what happens is you continue to get these awesome setups over and over and over. And by the time, you know, it was all said and done, I had, you know, my entire $1,000 was there, and you know, I dealer whatever, like dealer 1 or something, you know, and so I was out, but I was only out $1,000. So, you know, what I should have done, exactly that. There's nothing, you know, there's nothing wrong with the way I played, because over the course of whatever, you know, 1,000 hands, it works out. It just so happened that, one time I had a stop out that was my stop out, and I played it correctly, and it just didn't work. Again, that's the deal with statistics. So that's how we do it here. That's how we play this game, right? We know what market regime we're in, so we know what tools we need to apply. When we're in a different market regime, we don't have, we have the ability to say like, oh yeah, don't play that game. Easy. So let's get right to it. I know I've been going on for forever now, but I just wanted to make that point because, so many people have been emailing me or DMing me about what's going on and this, that, and the other, and the headline of the day, playing those markets because they think that they have to play that game. And, and I'm over here like, yeah, I don't know. I don't understand why you're stressing, man. We're doing all right. It's, still slow and steady for us. Those of us that did that relaunched a new prop tryout earlier this year. I know a couple of people have DM'd me that they've made it through their first round or second round and they're live. This last time we ran through it. I know we have a number of traders that have been live for a year or two now, but we're pretty much just kind of right there, about a third of the way, half of the way to our profit target during this crazy volatile market, right? During the market that's just crazy volatile, crazy wild. We're over there just making money, doing what we need to do, just playing out our odds. So let's do that. Let's get to our full analysis, see what's going on. First of all, let's just take a look at where currencies are. Get an understanding. This is 2022, basically all year. I think, yeah, pretty much 2022. So what's the story here? The dollar has just been going straight up and the yen just got punished. And now everything else is starting to participate. Okay, interesting. And it really was just kind of like the beginning of April that everything really, it was all kind of mishmash or whatever, but it really started to come down. Australia, Canada, New Zealand were doing quite well, while Europe, Great Britain and Switzerland were, starting to turn over already. And then the yen just really fell apart pretty much as soon as my call or my puts expired, pretty much the day. So, which is, the name of the game. Okay, so let's get right to it. Euro USD, bear quiet. The trade there's no trade. So let's take that one off. Okay, we got a VBO that has fired on the pound and it's off and running. So now I have to look I missed the entry on it. And so now it's no problem because what is my job is I don't need to catch these. I'm going to catch, a natural gas type trade 4 to 6 times a year. I'm going to catch. They're going to happen like daily and weekly. You're going to have these type of trades that you're like, oh man, I really wish I was in on that up here. Or boy, I really wish I would have shorted at 136. It was obviously a short at 136. Yeah, well, you didn't. So what your job is to figure out how to get into a move like that. Not figure out, use your strategy to get into a move like that late after it's done. So right now, everybody's sitting on the sidelines just saying, oh, I got to, I'm waiting for a pullback. I'm waiting for a pullback. And then this thing goes. And then they're sitting on the sidelines going, man, I just need to get in. And they get in eventually. And you know what happens? As soon as that happens, the market turns on a dime. So we don't use this FOMO method to get in. We don't use the worried I'm going to miss the best trade in the world. The pound is going to go to par with the dollar at $1. It's at 26 right now. It doesn't matter. That's cool to be a podcast host to come and or guest to go on and say that maybe, or go on CNBC and say that sort of stuff. But what we really need is a way to get in, because our job isn't to be Our job, if you're here watching this and you're doing it, my guess is our job's here to make money. Our job here is to make money. And how do we do that? Well, we've got our market regime figured out now. We know that we're in a bear market. It's starting to move. So let's take a look. How many times does the pound spends about 30% of its life in a bearish regime, 71% in a bullish, but a better distribution. Bear volatile 8%, bear quiet 20%, neutral and bull quiet. Pretty bear quiet, neutral, and bull quiet, pretty evenly distributed. That looks like a bell curve. 6% in bull volatile, 7% in bear volatile. So unlike equity indices, these things mean revert substantially more. They don't trade in a upward slope and then correct. That's usually not how currencies do. Because you have a lot of inflation and you have a lot of things. Currencies adjust. So if the value of the pound is going down, that means it's easier for them to sell to export. Right. And it's tougher for British British pound users, I guess. It's harder for them to buy out, travel, like to go to mainland Europe. They're having a little, well, we'll see how Euro GBP is trading, but their buying power is down outside their country, but inside their country, their buying power remains the same. 1 pound is 1 pound. So right here, all we've done is confirm we have a vol breakout, and now it's just, this would have been the trade. So on Sunday night, if we were doing what we should have done, we would have had our sell stop in here, and we would have been in, and we would already be up on this trade, but we didn't. Some of you might have, I didn't. So I'm going to say we, but I did not. And that's fine, because I know that I've got, hundreds of these trades per year. And I know that when I actually catch these big movers like that, these 8R, 10R, 20R moves, I know that I have the ability to get into them and catch, like I said, 4 to 6 every year. So if I'm making an average of like 2R a week, let's say, and you do that 52 weeks, it's about 100R. You're making about 100R 52 weeks out of the year at 2R per week on average. You're making 100R. 100R, if you're risking 1%, is 100%. But since it doesn't happen in just one trade, it happens over the course of 100 trades. It's actually more like 135 to 150%, depending on where you go with that. So it's actually, if you're risking 1%. Now, if you're risking 0.5%, then it's half that. If you're risking 0.25%, then it's 1/4 of that. Okay. And then, so you end up with, 150 or a little over 100R on that 52-week average. And then you add in 4 to 6, 10 to 20R trades, or 8 to 20R trades on that. Let's just say 8 times 4 is 32R. So you knock out your 132R at the end of the year. And you did it by showing up to work every day, taking these simple, 1 and 2R winner, 1.2 to 2R winners over and over and over. And then every now and again, you catch a good one. So let's say you get 6 8R winners. Now you're talking 48R out of 6 trades. And of course, what what you get is you get people who think, okay, yeah, I just got a nice 8R winner. And so now you're looking for, like on that natty trade, now you're always looking for the next 8R. Like you're always saying, okay, where is it at? I need, especially after you just came off one. If you just came off a heater, you're like, ooh, we need more of these. This felt great. I need to do it. But the disciplined systems trader, the person who's done their multiple thousand trade back test, that does daily practice, knows that what's going to happen is I'm going to get probably 100, 1 to 200 trades a year. And I'm going to average making about 1.3, 1.4R across those trades, because some of them are 2R profit targets and some of them are 1.2 profit targets. So you're going to average about, something like that, 1.3, 1.4R on the year per trade average win. And you know how many trades you're going to get. So I can pretty much anticipate how much money I'm going to make each year by the amount of money that I put in the account, right? So if I have a $100,000 account and I risk 1% per trade and I make about 100R, then I know that I, got 100%. So I've doubled my account size. And then if I add, 4 to 6 of those 8R winners, let's say, I got myself like, maybe 130, 150R on the year, 150%. And then it compounds because, once I've taken my first trade and I make, let's say 2R, it's now a $102,000 account. So I'm risking the 1% on 102. After 50 trades, maybe I'm at, 140, maybe I'm like $160,000 in the account after, half the year, let's say 60, 75,000 in the account. And then now I'm risking 1% risk is $1,600, not $1,000. So it continues. That's why position sizing is so important, because if you're maintaining that, if you're maintaining the percent risk per trade and not focused on a dollar amount or, like 100 shares or 1,000 shares, some arbitrary round number, that's where your edge really stacks up. So, all right, let's keep going. So we got pound. We're looking for now, VBO has been confirmed. I'm now looking for a late entry to this trend. So a VBO add or a VBO2. So we got our VBO on Aussie. Now we have confirmed. Look for failed or VBO2. Sorry, VBO2. So right now I know that on Aussie, I've got the VBO has been confirmed. I'm looking for a VBO2. So what's a VBO2? It's a way to get in later in the game. Kiwi's probably very similar. Okay, we got VBO confirmed. Sorry, VBO add. Did I try VBO2? I did VBO add. Yeah. So notice it's the same on pretty much all the USD pairs, right? So Euro, Pound, Aussie, Kiwi, all basically the same. So the dollar is ripping, and you can see it in dollar CAD. So now dollar CAD has a VBO setup today. So we'll look for it to be a VBO setup, or actually this is not confirmed. So let's do FVBO/VBO setup. So I need confirmation. Is it a VBO or an FVBO? I'm in a neutral market regime. So that would suggest that we're probably looking for an FVBO. And there you go. Okay. Easy enough. Got that. No FOMO. I don't need to chase this one. Dollar yen. We've had the same setup on all yen pairs. And the dollar yen has been the strongest of them all. We were in CAD yen, which would have been the second or third strongest. If we were to look at here. Aussie and CAD were the second strongest in the last few weeks. So we got in when we took that trade, we were in a good spot, but we didn't get the dollar yen. So that's cool. No big deal. Right now we're in bear volatile, big VBO. So we're just looking to see how this plays out. There's no trade at this point in time. I would be looking for a VBO add or a VBO2 to get in this thing, maybe to the upside. But there's no reason. And I would only be risking 1R. So the fear of being wrong is not that big a deal. Losing 1R, if you're averaging 60 to 70% wins, you're going to have a losing trade. A losing trade is not a mistake. A losing trade is just part of your strategy. They happen. You can't put your ego in the, you can't tie your ego to the outcome of you trading your strategy, because that's irrelevant. Your strategy is not you. it's not you. It doesn't represent how good of a student you are, how good of a thinker you are, how good of a son or daughter you are, how good of a parent you are. It only means that, all it is your job is to not be right or wrong, or not to win on or lose on the trade. Your job is to implement the strategy as good as you can. So irrelevant if this happens. So if we have a setup, we take it. And if it makes its 2R or we trail stop out, that's fine. If it stops out at 1R, that's fine. It's part of the system. Okay. This one was dollar franc has really just taken off. I've been looking for a VBO ad somewhere in here. And we haven't really had one yet. So it's a big breakout, and there's, it's not even at parity right now. And it spends a lot of time. The dollar franc pair spends a lot of time at parity. So, this is one I would be looking for, still looking for. Okay. So across the board, I have no setups right now. I'm looking for Aussie and Kiwi, Aussie, I should say, Aussie dollar. So in my notes, I have Aussie dollar written down as a VBO ad. So I'm just going to pay attention and wait for that. Okay, let's get off to Aussie yen, nothing. We got Aussie CAD. If it plays out right now, I don't think we're going to have a failed vol breakout. I don't think we have enough space. We do. Okay. So Aussie CAD potential. One second. Sorry about that. Okay, so potential setup on Aussie CAD. So I'm going to put that. AUDCAD. So now I write these down. And so at the end of the day, today, after the market closes, I come back and I look at all these and see where the setups are. I go through everything and it takes me a handful of minutes to do. No big deal. Aussie Kiwi got nothing. Aussie Franc got nothing. Last week, we had a lot going on with the Franc. So Aussie Singapore dollar, that is a VBO right there. I don't trade the Singapore dollar because it carries a lot higher on that. So you have to actually get a much bigger move to end up positive on the trade. So I just stay away from that. Off to the Euro pairs, nothing happening there. Euro CAD, potentially Euro CAD. VBO2. So also we're looking at right now, we're not looking at end of day. So who knows what this is going to look like at the end of the day, but I got a VBO2. Euro pound. Euro definitely going to pound town on the pound. So Euro yen, look at that failed breakout retest. It hit to our price target. That's a done trade. I didn't take the trade. That's a done trade. So it hit to our price target. So it's completed. So, all I would be seeing on this one is that it hit price target and it's done. It doesn't, you can't be like, oh, the Euro yen is, like, oh, it's done. It's hammered. Like you can have all these opinions all you want, but the reality is that bearish setup had completed. So it's reset now. There's no world that I'm looking at this saying, oh man, this is going to, 100. It's going to 100 easy. I got to be in it. That's not even any part of my calculus, because I know what market regime we're in. I know what setup just completed, and it's done. It's reset. It's just sitting there in the world doing its thing. It doesn't even, again, back to the casino, there's 1,000 tables that you could play at. You just need to find the one that you're going to play at, right? And if that's the case, this one is not one of those tables. Look at the Mexican peso. Got bear. That's a VBO2 right there. No fill for me. So Euro Aussie, no trade. There's no trade. Singapore dollar. South Africa. Thomas asks, I know a VBO2 has a pullback to the midline. A VBO add is a pullback to KC. No, it's a price action in a trend. So in let's say a downtrend. Okay, so we've got a VBO here. Okay, and then it goes. Here's a VBO add. The shooting star in a downtrend is a VBO add. A hammer in a downtrend that fails is a VBO add. You got it. CAD yen. So again, we got out at we got it. Like, this is just such a good example of, there was, so many places VBO ads along the way to get in. I just happened to get in last week on this one, and it ripped, and then it stopped, and then it dipped. And so as this one started to play out, I put my stop in, boom, I locked in profits and I reset. Now, again, in the casino, what am I looking at? That's gone. This is something that I'm not playing. It's a table that doesn't need to be played anymore. Even though, a lot of people, what happens is you just had a nice trade on CAD yen, and you look left and you see like this massive run, and all you're doing is drooling, thinking that you're going to get in. What happens if this thing just does nothing? So we'll look at the franc and the yen. Franc looking pretty weak there, which we saw in the dollar franc, how weak the franc was compared to the dollar. Pound yet, look at that one. Pound going to pound town. Pound just getting hammered. No trade. No trade. No trade. Off to pound. So we should start finding things in pound, because it's, okay. So we had a VBO. A VBO fired yesterday. What did I do? I didn't get it. Okay. So now I'm looking for a place to get in over here. Nothing exciting, but also I have Aussie CAD, Euro CAD, Pound CAD. So CAD strong. So I just need to find either the Aussie, the Euro, or the Pound is one of them, and they're all set up already. So I just go through and see which one it is. Not all of them. I'm definitely not going to go short Aussie CAD, Euro CAD, Pound CAD, because now I'm, instead of 1% risk per trade, I'm 3% risk on CAD, and CAD is you're trading the mix of those. You're not trading. It's not a separate trade on each one. That's like 3x leverage. Okay, nothing on the Kiwi. So CAD franc, mildly interesting. There was a fill vol breakout right there, and I don't know if that doesn't look like it's hit profit target yet. Again, you know what? I did not get this one. Oh, it has definitely hit profit target. Yeah. Nice. So if anybody of you took it, congrats. I did not. I missed this trade, and it had a VBO confirmed, and then that failed, and then you went into. So you could have gotten long your VBO, hit your, whatever 1R, move it to break even, And then when this one shows up, you move your stop up to here. So this could be 2 trades. Get about 0.3 R on this entry that pulls back here. And then when this forms, you put your stop and a short on this new setup. Oops. So this is a VBO that then fails and turns into a Feldwall breakout. And so you get 0.3 to 0.4 R on that one. And then on the reversal, you get your 1.2 R. So you end up walking away with like 1.5, 1.6 R on that trade, which, it's kind of nice. You pretty much spend a week trading the CAD franc, and you just had a wonderful trade. So let's look at NZD CAD. VBO add if hammer taken out to downside, and it was not. And now we have a VBO add if so if I get a move below today's shooting star, and I'm writing these on my charts so that I remember this information later when I'm going out today. I'm going to go hit the range. I got morning workout, lunch, out to the range. So I'm going to be shooting and running my afternoon workout out there at the range. And then I'll be back here. And now I've done my morning, reading and writing. I've done my live stream trading with you guys. I've got a workout in. I've had lunch. I've driven to the range. I've shot things. I got a workout in. I'm amped up. And, a bunch of life has happened. And now I'm back here at like 2 or 3 o'clock in the afternoon. And I'm like, what was that trade that I was looking at? And so I have another NZD CAD trade. So strong CAD across the board. So Aussie CAD, Euro CAD, Pound CAD, Kiwi CAD. I just need to find the one that does it. Right now, NZD CAD's looking pretty all right for me. NZD franc. And then these, exotics. I don't really, they're very hard to trade because you got to catch like massive moves to pay for the carry on those. Turkey is okay sometimes, but obviously it's busy. This is where a good Turkey trade works out is you catch that big move. You catch that big move that pays for the trade. You 9 to 15 and you're paying 10% to be in that trade. You gotta get a big move. Otherwise, this sort of stuff doesn't pay you anything. So you got to be a lender of lira to not a borrower. Ruble, look at that. It's amazing. Just that's what'll happen when you pay 20% interest, 20% carry on your currency in a world where everybody is the US dollar is what, 3%, 3 point whatever we're paying right now in the 10-year. They were paying 7%. So if you look who, you've got Turkey, you got Brazil, you've got Mexico, you've got Russia, and you've got, I think it was India. They were all right around that 7%, 7-8% interest on their currency. And so anybody who's in the Russian currency in January or February or March, knowing what was about to happen, is there for money, for the interest rate. They're not there for like other reasons. And so when the invasion happened and all the sanctions happened, all that sort of stuff, what did Russia do? Oh, we're going to pump it up to 20%. And so if you're already in Russia thinking, or if you're a trader who's like, yeah, I really want to, I'm going to take that yield out of Russia at 8, 7, 8, 9, 10%. And Turkey, you're in it because you need yield. If it doubles, all your money is you're going to be like, oh yeah, just think of DeFi. If you're sitting in a project that's at, paying out 8%, and then, you're like, oh, I don't know, Turkey, these ones are, paying out, they're all kind of paying out 10%. They're all kind of equal, right, as far as risk go. So you're playing a game of default anyway. And then somebody pops a 20% interest on it. You're like, well, I know where my money's going, because you're already a degen, right? Like you're already in that, you're already doing it. So you're not thinking to yourself, oh, I'm going to go running away from this whole Russia trade and go get, like 3% from the US. No, man, you're going to take that you're going to double your money. Okay, let's have a look at China. This has just been the China has just been getting clobbered. The yuan has been getting clobbered, and so we're back to that level a year ago. Look at that fast that move went. Boom, just a face rip. And then Hong Kong is getting to the peg. So last time we've been up to the peg, we're right there right now. That's it. Basically yesterday was I think, let me see what our peg is, 785. So we're at the peg on the USD Hong Kong dollar. And it pretty much just sits there, right? Does that for all of 2018, had some violent drops in 2018 when the world changed. And so it pegged right there, and it's pegged right now. Also, I learned peg has a different term in the gay community. It's something, I had some friends that are a gay couple, and we were talking about the markets, and I was talking about Euro franc, and like, when it lost the peg, and and they were like, say that again. It's like, oops, I did not know what that meant. They're like, let me tell you what you're talking about here real quick to some people. Okay, so we were looking at gold. Gold is definitely a fill vol breakout setup right now. One of our best performing fill vol breakout assets around, by the way. So that's definitely on my watch list. Silver on the watch list for fill vol breakout. Palladium off the watch list. Take a look at platinum. Platinum, we got a VBO. Well, it's not really confirmed. So, I'm just looking. I don't have to take all of these. Just because it's there doesn't mean that I have to do it. Copper. Now let's look at gold versus the euro, gold versus the Aussie, silver versus the euro. Nothing there. Let's get into Brent. Nothing on Brent. West Texas, nothing. Natty. I am looking for this setup to potentially happen, and that'll give us the VBO2. All right, back to indices. Okay. One thing that I've been watching is the high yield, and we got down to trouble. Last time we got into this area, 14th of March. So when was that? 14th of March, right? So we're there again. We're at the high yield. We're right back to where we were last time we bottomed. That we went a little lower, but it's not the precise line is not the important part. It's the area. This is a regime type filter. This is to say credit, the high yield credit, the corporate bond market is worried right now. It's down pretty quickly. Boom, just a fall. And last time, in 2018, this is where the Fed stopped doing their shenanigans. This was in 2015. This is COVID. So this area right here is fairly important, and we're there, right? So who knows what comes of it, but a reversal today would be really, really interesting and more expected today than not. And that also means if we don't reverse today and we break, then, it's probably a lot of risk is about to be exposed in the market, and you could get really extended. NASDAQ up about 0.5% since we were talking. Russell's holding up a little bit better. The Dow's holding up a lot better. The yen holding up, but just getting there. So the FTSE really, as the pound broke down, the FTSE started to break as well. Euro stocks, we've got the DAX, we've got France. So Europe holding up a lot better than the US markets. Canada fell apart pretty quickly there. Aussie, same sort of thing. Hong Kong, it's been falling apart for a while. And again, we got a fill vol breakout on China, but I don't trade China because I never back tested it. Off to commodities. Arabica, nothing. Robusta, nothing yet. Take a look. Corn, got into corn above yesterday's. So it's a VBO2 basically, or a VBO add. So I got in on that one here, and it's about break even. So mildly entertaining. If I get stopped out, I get stopped out. If it goes, it goes. Cotton had a nice reversal yesterday, and I'm going to keep an eye on cotton. It might be worth trading. OJ, nothing. Beans, nothing. Raw sugar, white sugar. I'll see what my position sizing requirements are going to be on sugar, but we have a potential on sugar. White. Let's look at US cocoa. I love cocoa as a fill vol breakout strategy. Right there. Yeah, that'll do. Cocoa's there. Keep an eye on that. UK cocoa, stronger than US cocoa. Wheat, doing nothing. All right, into the treasuries. US 10-year, big reversal last couple of days. So bonds have been bid pretty much since yesterday, which is a good sign. So that eases up the interest rate. Let's look at US 10-year. That's the yield. So the yields are starting to drop. We hit 2981, 2981, yeah, 2895. So we couldn't do 3% on the 10-year, and we're starting to pull back. Doesn't mean we're not going to get it. I mean, this is a VBO right here, right? This looks a lot like the dollar yen trade. So pulling back, but nothing interesting there. And then let's take a look at actually who Chris mentioned, Googs. Got a fill breakout long. Got a fill breakout long setup potentially on the Googs today going into earnings. Not trading it. Don't need to trade it. Not my job. I don't need to. Nothing fancy needs to be done here by me. That's it. That's my universe. I've got Aussie. I've got the CAD. I've got pound. I've got Kiwi. I've got gold and silver. I've got copper. I've got natty gas. I've got potentially NASDAQ. Let's take UK and Aussie off this list. Potentially something in S&P or NASDAQ on a reversal. Corn, cotton, sugar, and cocoa. I've got a bunch of opportunities to trade right now. Ultimately, it's going to be pretty much which one or two I choose by the end of the day and what my other positions are that I might be in. That's the only thing that's going to really determine it. So right there, that's how we're looking. Let's look at Bitcoin on the daily. Nothing interesting on Bitcoin. Ethereum, pretty much, you know, all the joy that was had yesterday, that big reversal candle is feeling the pain today. Same as equities. Same thing that yesterday's big up candle reversal on NASDAQ and S&P being, you know, jeered, not cheered today, as to be expected, Do you guys have anything you want to look at? Anything you guys want to look at before I cut it? So Bitcoin trailing stops on which, Steve? Or just generally? I'm not getting an answer from you. So let me just throw up, generally, like, do you use an ATR? No, I don't use, you can certainly use ATR. The way I do it is, let's say, the only time I'm using a trailing stop is if I'm in a VBO that is taken off. Okay, so let's have a look here on dollar yen. Let's say I took this trade. I didn't, but let's say I did. VBO, boom. You're long here. Okay, your stop's right here on your first trade. Now I have a VBO add that came into play. So now I raise my stop. I now resize the position. So now I have a buy stop above here. My stop is here. And that tells me, you know, let's say I have $100,000 in this one. Now this second one means I need to add another 12,000 to it. Okay. So I moved my stop up and my stop is, you know, below the low here. And then let's say I had another one here. So right now, as this one goes up, I would be at 2R, I'm bringing it up to 1R. At 3R, I'm thinking, okay, up to 2R. And then I had another VBO, you know, VBO, whatever I didn't, this is the next one. So the next one says I'm at 112,000, 100,000 here, 112,000 here. I should be at 160,000 here, let's say, or 190,000 here. So I don't leave my stop back in those areas. I move my stop up to this. I treat it as a new signal. Okay. So if this goes, now here's my new stop and it didn't fill. Okay. And then I had another VBO. So I go in here and my stop's basically going to be the same. So even though you know, you're saying you should add here, but it's basically the same trade. So it wouldn't have been an additional entry. And then this one comes up, and now this is a nice small one. If you don't know anything about position sizing, this is the huge edge that you get with position sizing, because now this trade is tight. So if I'm at 160,000 on this one, now my new range is here. I'm at like 250. I've now just added a whole $100,000 position to this because my stop's here and my entry's here. And if this pulls back, I lose 1R. Nice and tight. Because I've already locked in, like, I don't know, probably like 4 or 6R already on the original position. So now I have another one. Now I'm at like 250,000. Boom. Another one. I'm probably at like 300,000 here. And I've just raised my stop up each time I get a new signal, I raise my stop up, no entry. This becomes a new one. I'm in there, no entry. We go up here and now it gets up, and, you know, so my stop would have been here. And on this one, if I would have used this as an add, I would have put my stop right here. I would have taken a 1R loss on this one, but made like a 20R all along the way. Or if I didn't add, my stop is still here, or maybe even up to, you know, if I'm feeling like I want to keep it tight, I may trail stop up because I've got, you know, 10 to 15R already. So as new VBO ads happen, I raise my stop to that. I treat a VBO ad as a completely new trade. So I'm not looking back, resting on my laurels because I got in over here. I'm trading with these as being completely new trades, even though I'm just adding to the position. And when I say, you know, because we're talking about currencies, I'm adding dollar value to it. I'm not buying contracts. But if you were doing like a contract-based thing, then basically if I go in like one contract here, and then this next one comes in and it tells me my position size should be 3 contracts, I just add 2 contracts. And if it tells me my contract size should be 4 contracts, I add 1 contract here. I'm not just, you know, blindly throwing in new position size. And then when I get up to like, let's go this one right here. If it tells me like my contract should be 12 contracts. So now I'm in 12 contracts here because my stop is right here. My entry is right here. It's a very tight one, 1R, 2R, right? And then, so now I've got 12 and I get in and it tells me, because of this new one, it tells me my trade should be 10R. I can raise my stop and not do anything. And so that's pretty much just how it works. Is that clear? Each new signal is a new position size, adjusted up or down. and then that's where your stop is now. So I'm not just leaving my stop here or some magic ATR. ATR is fine, by the way. I don't mean to be dismissive of using ATR as a stop. It's a great strategy, very mechanical. So if your range is, if you have an ATR on there, if your range, like the last, whatever range, 5-day ATR, whatever you're using, if that gets breached, then you're no longer in your wheelhouse, right? It's outside the statistical edge that you have. Is that good? Yeah, stops are a little more crucial with that, with Apex. Yes. Yeah, because you can only lose 2.5%, right? So I was doing a 0.10% risk on Apex, using 0.10% risk day trading for position sizing on Apex, and that gives you a lot of breathing room, right? If you have a 50% win rate and you're making, 2R on your winners, 1R on your losers, you're going to be fine, and just stick with a 0.10. If you're doing discretionary on Apex, I might even consider doing 0.5% risk or 0.05% risk. If you're doing a system on Apex, then you should be able to know what your risk is. At 0.10, you should be fine. Maybe even at 0.20, depending on what you're doing. Like if you're doing scalpy on day trading futures, and you should know what your win rates are, your stops, and everything like that, then you can easily size your positions. But if you have an ATR, if you're using the ATR with scalpy, then it should tell you, what you're at, where you would be wrong. For me, when I use scalpy, I'm either doing a directional thing, as opposed to the mean reversion side of it a little bit more. So I'm trying to buy. If it's a the 10, 5, and 2 are all up, and I get a move to the bottom of the range, then I'm adjusting, trail stopping along the way. I'm not doing 2R exiting on those. I'm trail stopping, but I tighten it up around 2R usually. And sometimes if I'm just kind of if it's just a mechanical thing, I'll just put 2R exit and walk away and just let it stop it at 1R or 2R profit target. All right, I am out of here. Have a wonderful day, guys. It was a blast going over this with you, as it is every day. Again, I'm going to send this one out to the email list later today. You guys got it real time. They'll get it later today when I get it published. That's that. Have a wonderful day, everybody. I love you all. Bye.